Hello and welcome to this special show where we are tracking the CPI data, the consumer price inflation data for the month of October, and that has softened to a sub 7% figure. We were expecting it to probably come in sub 7%. This is the indication from the Reserve Bank of India governor as well, and it has come in at levels of I think around 6.77%, which was in line with our expectations. Our poll had thrown up a figure of around 6.73%. So there is definitely softness. This is the best figure that we've seen in terms of the CPI data all the way back since July. So it's a 2-month low that we are seeing coming in for the CPI data. Sub 7% figure is where it's coming at. We'll wait by for the food and beverage inflation data because that is expected to moderate from levels of around 8.41% that we had seen in September of 2022. So we will wait by for that. There is expected to be a softness in the core CPI data as well this time round. So our expectations is that the core CPI could probably soften to around 5.9% versus around 6.1% in the previous month. So good going coming in for the CPI data. Let's get in our guests now. Remember that we also had the WPI data for the month of October, and that came in at in single digits at around 8.4% versus an over 10% figure in the previous month. So it broke that 18-month long trend of double-digit WPI inflation to come in at single digits. Aditi Nair of ICRA, Anubhuti Sahai of Stanchart, and Rupa Nitsuri of L&T Financial Services, Amandeep Chopra of UTIMF. All of them are with us this evening to discuss the CPI data. Welcome, ladies as well as gentlemen. Aditi, I'll start with you. What is your reading? The CPI data is coming at around 6.77%. The street was anticipating a sub 7% figure. What is your reading?
Thanks. We were looking at a 6.7% CPI print today. So what's come in is just a little bit higher than expected. Food and some of the other components are in line, but I think miscellaneous has come in about 10 basis points higher than what we were factoring in. So within that, we need to just take a look and see if it's that feared acceleration of the momentum in services inflation, because that's something that could become sticky going ahead. But otherwise, I would say that the print overall is pretty much along expected lines.
Okay, well, we are waiting by for additional data to come through at this point in time. But Anubhuti, what's your sense? Because it's a sub 7% figure. We're waiting by for the food and beverage inflation. But Aditi did allude to probably the miscellaneous inflation, which is higher. We need to watch out for the services. What is your sense and reading about this particular inflation reading for the month of October?
The number is slightly higher than our expectation. We were looking at 6.6%, so it's almost like 17 basis points higher. We were expecting much of the deceleration to come from food front, so I think we will need to wait for internals if food, primarily to assess whether food softened as we expected, or is there still some bit of stickiness on that. On core, excluding transport and communication, we do not expect as of now much change from the previous month, but I think internals would be very interesting to watch out for. And if this stickiness is coming from food front, then we can think about better price trends going forward. But if this is primarily emanating from core, especially excluding transport and communication, then that can keep us a little cautious on the path of downward trajectory for CPI.
Okay, well, we do have a couple of internals, and I'm just going to read it out for you. We have the food price inflation, in fact, which is coming at around 7.01%. We have vegetables inflation, which has come in and softened all the way to around 7.77% this month. This compares to over around 18% Fuel and light inflation too has come below 10% in terms of a figure. We have rural inflation, which is coming at around 6.98 versus 7.56%. But Anubhuti, just a second follow-up question with regards to food price, because you were looking out for whether or not that's going to be sticky. So food price inflation has come in at around 7.01%. Vegetables has softened quite significantly. Pulses too has come in at around 2.78 versus 3%. Your reading as a whole for the food price inflation, what were your estimates versus the 7% figure?
So on, as I was highlighting at the surprise or the upside surprise to a 6.6% forecast has primarily come from food. We quickly estimated core, which is pretty much in line with our expectation of 5.97. So it has softened from above 6% last month. Now, you're right that whatever softness we have seen is in food is apparent when you're looking at vegetables, or even for that matter, say rice. But there was a far more favorable base effect in our view for food and beverages, which has not played out. And this effectively leaves some space for further softening in food prices as we move to the next month, that is the November print. We were looking at the first 12 to 13 days of November food prices, the retail prices, which are available on daily basis. And we don't see much of an uptick. In fact, it's pretty much range bound. So I think to that extent, the upside surprise has come from food, given that we are not seeing much upward pressure from here onwards on food front. Possibly in November, we can see further softening, given that the base effect remains extremely favorable here.
Okay, well, we also have the core CPI data, which is still sticky, you'd have to say. So we were anticipating it to probably soften to a sub 6% figure. It's come in at around 6 odd percent versus expectations of 5.9% and versus 6.1% in the previous month. Amandeep, I wanted your thoughts in terms of how the bond markets will probably read this data. Do you think that most of it is factored in a sub 7% figure in any case, and this is in line with the softening inflation that we've seen globally?
That's quite true. I think the markets are already expecting a number closer to 6.7, which was broadly the consensus estimate for quite some time, even before the numbers released today. So the markets had already factored in and were sort of rallying on the back of that. We've seen more or less a similar pattern emerging elsewhere also. So you've seen commodities, broadly decline from the peak of June. Oil, thankfully, has continued to remain soft, and we've not seen any retail fuel price hikes, over the last few months. So I think all that has, in a way, led to the expectation in terms of softening of the inflation. Going ahead, I would say that there are favorable base effects as we move into November and December monthly prints as well, which will be helpful. So, yeah. Going ahead, I would say incrementally there isn't any significant data for markets to rally further from here. But if we were looking at maybe some bit of undershoot going ahead, then I guess markets could possibly start building in some expectations as we move into the December RBI policy meet.
Okay. Well, Amandeep, I'm going to come back to you in terms of what the RBI expectation would be, whether or not there would be any sort of expectations on softness in terms of the trajectory going forward when it comes to rate hikes, or a lesser number of rate hikes expected. But before that, Rupa, I wanted your thoughts in terms of the CPI data and your reading as well in terms of what the next one or two readings for CPI could be, considering that we've seen softness globally in terms of inflation readings emerging out of the US.
Yeah, actually, I was expecting it to be 6.88%. It has come out to be 6.77%. As said by the other panelists, huge statistical base effect has helped both the food and beverages inflation as well as fuel inflation, because last year around this time we had seen steep spikes in fuel prices as well as edible oil prices. So both of them have helped. Going ahead also, statistical base effect is going to stay highly favorable. I was not so sanguine on core inflation, so my projection was 6.04%. Of course, it has softened, but it is, I was expecting it to be in the close neighborhood of 6%. And you see, we have recently received also the business inflation expectations, survey of IIMA. And there also we had seen that 1 year ahead inflation expectations have softened. So Reserve Bank of India actually is expecting CPI inflation to be to average around 6.5%. in October to December quarter. So going by today's print and whatever is happening globally and to our domestic food prices, etc., I think there is a very high probability that their projection will be achieved.
Okay, you're right. Actually, the RBI has an expectation of 6.5% in terms of CPI data for Q3 of FY23, and then it's further reduced to 5.8% in Q4 of FY23. Amandeep, is there any expectations of a downside risk to these estimates, which the bond market might be factoring in?
I think the
Okay, I think we've lost Amandeep. We're just going to get back and connect him back to that. Aditi, what is your sense? Do you think that we can achieve, 5.8% in Q4 when it comes to the CPI data?
So, Ekta, I think that the next couple of prints that we're going to have for the CPI could be significantly lower than where we are today. So, low 6% or maybe 6% also, depending on how the food prices turn out and what is the trajectory for perishables going ahead. And so I think this quarter we might undershoot the MPC's projection. Next quarter will be very close. It will be between 5.8 to 6%, depending again on how the global factors and the food factors play out. But overall, I think we're going to end up this year fairly close to that 6.7% estimated by the MPC. The downside will be limited maximum to about 10 basis points.
Okay, all right. So you're expecting 6.7% to be achieved. Amandeep, we lost you there. Just wanted your sense in terms of whether or not you are, or the bond markets are rather confident about the RBI targets of, 6.5% for Q3, 5.8% for Q4, and as a whole 6.7% for FY23.
So I think, while a single data point does not make a trend, but clearly the markets are pricing in a downward sloping trajectory for inflation. So this data print at 6.77 does in a way, lead to some degree of comfort in believing RBI's projections for Q3, which is at 6.5. I think, like I mentioned, you do have favorable base effects continuing through rest of this financial year. So the incremental benefit that you will see in terms of the year-on-year figures will be positive. So this downward sloping trajectory is helpful, which is also where I guess the markets will start building in a much more benign expectations from the next RBI policy meet. Currently the market is divided between 25 to 35 basis point in terms of rate hike from the December meet. I suppose, given this inflation print and the expectation that going ahead, the next two numbers are also going to be lower, will possibly drive up those expectations a bit stronger.
Okay, all right. We're going to do one thing. We'll take a short break, but on the other side, we're going to continue our conversation and really quiz our panelists on whether or not they do expect the RBI to soften its stance and what they're probably expecting in the next 2 weeks as well. Welcome back. Well, we are still discussing the CPI data for the month of October, which in fact has come in at a sub 7% figure. We have Aditi Nair of ICRA, Anubhati Sahai of Stancy, as well as Rupa Rege Nitsuri of L&T Financial Services and Amandeep Chopra of UTIMF, all of them discussing this with us this evening. Anubhuti, we were discussing that services, in fact, might be a bit of a spoil sport this time. Have you managed to look at the data when it comes to the services CPI for the month of October and what the trend might be looking at or pointing towards?
Detailed internals, I'll still have to look, but as I highlighted earlier, core inflation at 5.97% is pretty much in line with our expectation. I think within core, especially if you take out transport and communication, there is a fair bit of a rotation theme which is playing out. So, for instance, if we look at some of the subcomponents, for instance, recreational services, or for that matter, health, we have over the past few months clearly seen a slowdown in inflation. Though inflation in these subsegments are still high, but they have clearly moved lower when you compare it to, say, 1 year before. At the same time, core X transport and communication has not changed much on a headline basis. It's still closer to, say, 6.2, primarily because the space created by lower inflation in recreational services, or for that matter, health, has been taken up by education. So education was sub 4%. Now it is trading, now it's printing closer to 5.5%, 5.6%. Similarly, if you look at housing, it was sub 4% for a long time, and now it has reverted towards 4.6%. And we do see further room for higher inflation, especially in housing, because housing rentals are going up, and it will show up even in a larger quantum going forward. So on a net basis, the broader point is that there is a rotational theme which is playing as we speak now, and which is likely to stay a theme over next 6 to 12 months. And at a broader level, core inflation is unlikely to go anywhere below 5.8 or 5.7%. Core inflation is sticky, or has been sticky till now, and it will remain sticky even going forward in fiscal year 24, which effectively will make RBI's task of achieving a lower inflation print towards 5% pretty much contingent on weather conditions and how food prices fare out.
Okay, well, rural inflation is probably impacted by food prices, but nonetheless, Amandeep, I wanted your thoughts in terms of how much you expect from the RBI in terms of rate hikes when they meet in December.
Ekta, I think like I mentioned, clearly, these kind of inflation prints will make the markets a bit more enthused in terms of a benign, action from RBI. I think early the markets were pricing in between 25 to 35 basis point. I would say that the balance now tilts towards 25. There are obviously outliers in the market who feel that given some bit of dissent within the MPC, you may actually see maybe a bit of a pause as well in December. But I think at the current juncture, a pause possibly is not really built into our set of expectations. But a 25 basis point, I think, would be given, which should be maybe a bit of a gradual, process towards hiking towards what the market believes is a terminal policy rate around 6.5. Since the peak of November, the swaps are clearly indicating some bit of decline in their terminal repo rate expectations. So they've actually come down by 40 basis point. So which sort of aligns it very close to 6.5, 6.6 kind of band.
Okay. All right. So you're not expecting a pause to come through in December. But Rupa, what are your thoughts? How much do you expect the RBI to probably move by in December? And what do you expect the trajectory to be as well henceforth?
Personally, I feel that RBI will certainly consider reducing the pace of tightening, because we have seen that even in recent industrial production data, you see the consumer goods growth is still negative. And we are seeing in many categories very strong rural-urban divide when it comes to consumption indicators. Just take the case of two-wheelers. I mean, we are seeing, during festival season, a very good pickup in two-wheeler sales in urban areas, led by scooter sales. But motorcycles, mopeds, etc., which are consumed by rural folks, there we are still seeing very modest growth or degrowth. So this kind of divide continues. We had seen that 2 MPC members had already warned that, one has asked for a pause and other is saying we need to reduce the pace of tightening because demand is still fragile. And so I feel going forward, they will look at various other data points besides inflation. Like we will get to see more of corporate earning results. We will also see bank credit growth, its sectoral deployment, passenger vehicle sales. All these data points are due in coming months. So they will certainly take that into account before deciding upon the actual magnitude of rate hike during December policy meeting. But I strongly expect them to reduce the pace of tightening. Of course, everybody knows that the need for tightening is still not over, and they will have to continue doing that. But the actual pace will be decided by the high frequency data indicators. And, going ahead, as we had earlier said, the statistical base effect is going to be very favorable. But that's not the only point. Even Reserve Bank of India's aggressive action so far for 4 consecutive meetings, that are also controlling the overheating. And at the margin, we are seeing, demand for many leveraged products getting contracted. For instance, at the margin, demand for affordable houses, loans for affordable houses, or small ticket loans or two-wheelers, also the demand is leveraged. We are seeing interest rate hikes impacting demand for these leveraged products. So, so they will wait, to see more consumption indicators before making the final choice of actual magnitude.
Okay, all right. So the quantum could be less. Anubhuti, what's your sense? There are expectations that it could probably be 25 to 30 basis points. Does this CPI data give you enough confidence that the RBI might move only to that extent in the next, 2 weeks, following 2 weeks?
Pace of rate increase would definitely slow, but we are in the camp of a 35 basis points increase in December, followed by 25 basis points in Feb, taking the terminal repo rate at 6.5. I think just one point which I would like to mention is we'll also, besides the domestic inflation story, we'll need to keep a very close eye on what's happening globally, especially to the Fed funds target rate, where they finally peak. And that would become another important determinant on where repo rate would finally peak out. But right now, our view is 6.5% for terminal, 35 basis points for December.
Okay, all right, Aditi, what is your sense in terms of the terminal repo rate as well as the expectations for December?
So in December, we're expecting a 35 basis points rate hike. As everybody said, a slower pace from what we've been seeing in the last few meetings. So definitely less than 50 basis points. Since the inflation is still running well above 6%, we think 35 basis points is warranted. And also, we do expect that the GDP data for Q2, which is going to be released later this month, that is possibly going to project a growth which is, which is slightly higher than the MPC's own forecast for Q2. So that's another reason why we think that while the pace of the rate hike will slow down, we do think it's going to be about 35 basis points and not lower than that in the upcoming policy review. Okay. As far as February is concerned, I think lots of things are still at play. Global factors, also the budget, what kind of fiscal impulse comes through the budget. So it's difficult to say at this point in time what February is going to bring. I think February should be a very much data dependent call, depending on how all of these factors play out by then.
Okay, all right. Aditi, Anubhuti and Amandeep as well as Rupa, thank you very much for joining into this conversation and discussing the CPI data for the month of October, which in fact has come in at around 6.7% in line with estimates, but definitely a big relief considering that it is a sub 7% figure. With that, it's a wrap. More news on the other side. Stay tuned.